Hello students, I am Professor Y.K. Chaudhari, Department of Commerce, KTHM College, Nasi. Today we discuss the topic here, shares and mutual funds, in that specially mutual funds. In the last video, we will see the introduction of shares, various types of shares, and the practical example of shares. In that video, we'll see the first theoretical approach of this concept, that is mutual funds, and then after the second video, we solve some practical examples. So first, the mutual funds. The words mutual funds by the name itself say it's a mutual contract between the fund house and the investors. Fund house means the mutual funds companies or any other institutions, and the investors. It is a pool of money from different individuals like you and me. When the fund house collect the money, it would have mentioned in the fund agreement where all the money is going to be invested. Mutual fund usually will have certain name which may be in line with the objective of the fund, that is growth fund, diversified fund, large cap fund, debt fund, middle cap fund, small cap fund, etc. By the name of the fund, you can understand where the fund house is intended to invest. When the mutual fund collect the entire capital, it divides the total value of the fund into smaller units, which is called as NAV. NAV means net asset value. To give you example, if the fund is starting with 1 crore, it split the amount in smaller unit of 1 lakh. So now you have price 100 per unit. The NAV is 100, which will be published on the exchange. Individuals looking to invest in the fund can look at the NAV and invest in the fund. This NAV is bound to go up and down as the investment done in the large cap companies will be listed on stock exchange, and their stock price will have movement due to changes in their working and also due to demand and supply. In India, mutual funds are regulated by Association of Mutual Funds in India, that is AMFI. Now I will share the working of the fund. For example, if a fund is large cap fund, the fund will pick up few large capitalization stock companies by highest market capitalization, same as the other funds also. So this is the concept of mutual funds. In further part, we also talk about mutual funds, benefits, advantages, risks, and some other concept related to the mutual funds. So after see the meaning of the concept mutual funds, we see the objective of this video. To understand the concept of mutual funds, benefits of mutual funds, and different concepts related to the mutual fund, and to solve the problems for the mutual fund schemes, understood better way for students in future to invest money in a various schemes related to the mutual fund schemes. So here mutual fund concept introduction. Whenever a person has money to invest, he weigh various options. In olden days, people had only two choices, namely gold and land. After the introduction formal banking system, people started earning by way of interest on their bank deposits. Due to corporate world, a new avenue was opened to the people, namely share market. And mutual fund, it is also the part of this new avenue. Mutual fund is a step forward which tries to minimize the risks one faces in the stock market. The mutual fund industry in India began in the 1963 with the formation of Unit Trust of India, that is UTI. Much later, in 1987, SBI Mutual Fund was the first non-UTI mutual fund in India. Today, there are 43 assets under management, means AUMS, of mutual funds in India, and the total number of mutual fund scheme in around 2,800. An investment program funded by shareholders that trades in diversified holding and professionally managed is called as mutual fund. This is the simple definition of the word mutual fund. Mutual fund can be considered basket of investments. Each basket holds dozens or hundreds of stocks or bonds. Mutual fund can be summarized in simplicity, diversity, and accessibility. A mutual fund is basically at less risk as compared to shares. All the profit or losses of the fund are shared by all the investors in the some proportion as the amount of contribution made by them. Mutual fund investment are subject to market risks. Now here we see the types or categories of mutual funds. There are thousands of mutual funds, but they can be divided into stock funds and bond funds. All mutual funds fall into two broad categories, open-ended funds and closed-ended funds. So first, mutual funds are of two types, open-ended and closed-ended. In open-ended funds, investors do not have any restriction on investment and withdrawal, meaning to say they can enter and exit any point in time. The funds are always open for investment and withdrawal. It is called as open-ended funds. This scheme do not have a fixed maturity period. So in order to determine the value of a share in open-ended fund, at any time a number called net asset value is used. Investor can buy and sell his unit at net asset value, which are declared on a daily basis. The majority of mutual funds are open-ended. The second types of mutual funds, that is closed-ended fund, whereas that's not the case with closed-ended fund. It will be open for investment only for a certain period, a month, and will be locked for a certain duration like 3 years or 5 years. Your money is blocked for 3 years period, so you may not withdraw it even in dear need. Both these types of fund has its own advantages and disadvantages and cater to different kind of people. You can choose which type suit you the best. Close-ended funds are not redeemable and usually listed on a recognized stock exchange. This fund also known as a closed-ended investment or closed-end mutual funds. These mutual fund schemes disclose any fee generally or weekly basis. So now we see here the NAV, that is net asset value. A mutual fund price per share or unit is called net asset value. All mutual funds buy and sells order or process at the NAV of the trade date. NAV may represent the value of the total equity. It is calculated by dividing the total value of all assets in a portfolio minus all its liability. So now we discuss the deal with the advantages of investment in mutual fund. So first advantage is professional management. The fund manager do the research and select securities. They monitor the performance of the securities regularly. And the second one is risk diversification. Since the mutual fund invests in various companies, industries, it helps to lower risk of the investor. And third one is liquidity. Mutual fund investors can easily redeem their units at any time at a certain terms and condition. And fourth one is affordability. Most mutual funds set a relatively low amount for initial investment and subsequent purchases. This helps a person with marginal saving to invest in mutual funds. These are the advantages of investment in mutual funds. Is your question in your mind risk in mutual funds? So yes, all funds carry some level of risk. If the value of securities held by a fund goes down, investors may lose some money. As mutual funds invest in market or government bonds, these are the bonds to face risks like market risk, credit risk, interest rate risk, default risk, political risks, etc. So invest your money cautiously. Investments are subject to market risk. Please read the document carefully. This type of slogans and instructions and disclaimer also show in the TV, radios, newspapers. So you invest your money cautiously and smartly. Now we see the concept related to the mutual fund, that is entry load and exit load. In a mutual fund, some asset management companies have sale charges or loads on their funds, that is entry load and exit load, to compensate for distribution cost. So first, entry load. Entry load is charged at the time an investor purchases the units, whereas exit load is charged at the time of sale of all units. So entry load is related to the purchase time and exit load is related to the sale of time. So here we see the practical example related to the entry load and the exit load, that is, if the NAV, mean net asset value, is rupees 1000 and the entry load is 1%, then the purchase price of one unit is rupees 1010. Similarly, if the NAV is rupees 1000 and the exit load is 1%, then selling price of one unit is rupees 990. That is, if unit are purchased, the entry load are added, and for selling units exit load are subtracted. This is the simple thing, you must remember it here. Entry load must be added in the initial investment and the exit load subtracted for the initial investment. So we see here some basic formulas related to the practical examples for mutual funds. If there is no entry load, that time we have calculated number of unit purchase is equal to amount invested upon NAV of first unit. If there is entry load, actual price amount of one unit is equal to NAV plus entry load. When we solve the practical example, that time you understood very clearly. Right now you just remember these things. Number of unit purchase is equal to amount invested upon actual purchase NAV of one unit. This is the very simple and basic formula. Now second, when the absolute change in net asset value, NAV at the end of year minus NAV at beginning of the year. Now the second, percentage change in NAV. When that time percentage change in net asset value, that time we calculate absolute change in NAV upon NAV at beginning of the year into 100. This is the second formula, absolute change and percentage change in the net asset values. So thanks for watching. You can comment or contact if you require more details. Click upvote or share if you like. Hope this helped. Have a nice day. Thank you. Thank you very much.